Interest rates remain broadly low, but there are a few pockets where you can find double-digit yields right now. Here to talk about that with me is Jeff Gundlach. He's the CEO of Doubleline. Jeff, how are you?
Good. Good to be here.
So you mentioned a few different ideas. They are Annaly, which is a mortgage REIT.
Annaly, the ticker's NLY on the New York Stock Exchange.
Okay, and Puerto Rico GOs, Puerto Rico municipal bonds,
right,
and energy bonds. Now, if you could just run me through each of those. These are obviously, higher yield, maybe some riskier ideas, but you've got a way to also provide protection and hedge against problems down the road. So let's talk about each one of these. What do you like about each right now?
Well, you introduced them in rank order of risk, so that's good. The Annaly is actually the lowest risk, I think, for the near term. It's a mortgage REIT that basically buys mortgage securities and then leverages them, which creates risk and interest rate risk. But I believe the Fed's not going to raise interest rates anytime soon, and that long-term interest rates are range-bound. And so this is an environment where the 12% type of dividend yield that Annaly offers looks to be stable and one where you can rely on that. So that's a 12% earner.
12% yield. If the Fed raises rates, it becomes more expensive for them to fund their positions, and maybe the shares get hurt. But if the Fed stays put for a while, then you collect that big dividend yield and use it well.
That's correct. And I think the price goes up because it's trading at a substantial discount from the value of the portfolio.
People are maybe anticipating that hike. And if it doesn't happen.
I think it's one of the reasons why the REIT sector broadly has been weak in the last 18 months or so is because of the fear of the Fed raising rates.
What about Puerto Rico general obligation bonds? Everyone's been fleeing from Puerto Rico. Everyone's talking about how do I find a bond fund that doesn't have any Puerto Rico exposure, but you say...
That's why they're down.
Right, you say there's it's time perhaps...
The 8% coupon GOs that were first sold in 2014 got to a price of about 95, and today they're at more like 75 with an 8 coupon. So you're talking a bit,
gets you to a double-digit yield.
You're talking about a 12 yield, and one that for individual investors is particularly juicy because it's triple tax-free. There's no tax. So the taxable equivalent yield for us high-bracket Californians is like 24%.
No matter what state you're in, you do well with the...
Triple tax-free, and you have constitutional protection. Now, they can change the Constitution if they really want to try hard enough, but they really have a hard time not paying those bonds in the scheme of things. And I believe that at 75, even a restructuring isn't going to be that painful.
You think they'll come up with a way to get through this crisis that'll be beneficial to those bondholders?
I think the bondholders will either have a home run with a 100 cent on the dollar payback, or it'll be restructured and they make it around 75 or 80, which is basically your cost. So you're clipping that 8
single or a double, or yeah. Okay, and energy
bonds are the riskiest because the fundamentals are bad. The price of oil crashed by 50%, and it doesn't show signs of really meaningfully improving from around $45 or $50 a barrel. And many energy companies will have problems in 2016 if oil prices stay at the level they are today. So these are risky, but they can yield 15%. Now, if you're going to buy energy bonds, I want you to also buy something that everybody really hates, which is 30-year U.S. Treasury bonds, because they work very well together.
This provides the protection, and how so?
It's a hedge, because energy bonds will drop in value if commodity prices stay low, or certainly won't go up in value if commodity prices stay low, and some will default. But if commodity prices stay low, Treasury yields aren't going higher. And so if oil then moves, if oil goes down, Treasury yields are almost certain to go down. You'll get a profit on those bonds. And if oil goes back up, your treasuries might get hurt a little bit, but your energy bonds will probably go up 30 or 40%. So you're basically putting together a low-yielding safety thing, the treasuries, with a high-yielding risky thing, neutralizing much of the risk, and creating a yield that's about triple what a normal bond portfolio would offer.
And you're getting a few percent on the long treasuries, you're getting double-digit yields on some of these riskier items, so maybe end up with either high single?
High singles, I think, yeah. Depending how much risk you're willing to take. You could buy 15%, glue it together with 3 to get 9 if you did it 50-50.
Not bad in an environment where there's not a lot of yield to be had.
That's right. So what's nice about the environment now is there is yield to be had in various places. 2 years ago, there was no yield anywhere. Junk bonds were yielding 5%. But now there's pockets of distress. It's okay to take advantage of them. You've got to make sure you hedge it with some safety, though.
Really interesting ideas, Jeff. Thanks for sharing them with us.
Thank you.